Hey everyone, welcome to the video for Workshop 7. This is the final video for Accounting 201. Congratulations, you're almost done with your first course at Indian Wesleyan's Degree Completion Program. Pat yourself on the back. I'm sure most of you have done well, and I've enjoyed communicating with you in the discussion forum and helping you out on feedback in these videos. Hopefully you've been watching them somewhat regularly. Let's talk about chapters 11 and 12. Chapter 11 is about corporations, which by far have the largest amount of revenue for any type of business in the United States. So you can think about all the different types of companies that are out there. We looked at sole proprietorships, partnerships, and corporations. You think of all the little mom and pop shops that are sole proprietorships, one individual owner, but how small those are when you compare them to like Walmart and ExxonMobil, those type of huge companies. Like the disparity between the revenue production of corporations and all other types of companies is vast. So we're dealing with the major types of companies when we look at corporations, and what are the main advantages and disadvantages of these. We talked about these a little bit earlier in the course, but let's look at those one more time. The first one is limited liability. What is limited liability? Well, that basically says my risk is limited to the amount that I actually invest as a stockholder in the corporation. Remember Enron a couple years ago, you weren't around at that time or weren't paying attention to business at that time. In 2001, late 2001, Enron basically collapsed into bankruptcy and went out of business. So if I had invested $10,000 in Enron in the year 2000, my risk would be limited to that amount of stock that I held if that company went down. They would not be able to come after my house or my cars or any personal assets because my investment is limited as a stockholder to just what I invest in my stock. Now, if you have a sole proprietorship or partnership, you're going to be at risk for more of your personal assets. There's not that clear dividing line between what is yours as a person and what is invested in the corporation. So that's the main advantage. Also, the ease of capital accumulation. So we can bring in all these different people as investors, raise capital to expand our operations through the corporation format. The disadvantages are extensive regulation. This is probably the key disadvantage because there are public stockholders out there who the government is trying to protect. There's so many regulations nowadays. My previous job was Director of Outside Reporting at Hastings Entertainment, and what I did was basically file the documents which were required by the government and investors so that we could be transparent with our information and disclose all this. Now, if we were a sole proprietorship or partnership, we don't have to issue our financial statements and say how much money we made, what our financial position is. We keep that all internal. There's a lot fewer regulations if you're a sole proprietorship or partnership. And also double taxation. What does that mean? Well, the corporation, remember, is a separate entity where we have a corporation's business on this side, individual stuff on this side. So the corporation, when we determine our net income, is going to pay a tax of around 35 to 40% on the corporation's income. Now, when that money is distributed to stockholders, they're going to receive it as personal income, and they're going to pay a tax on it again. So it gets double taxed. Whereas if we were just a sole proprietorship, we would just pay a tax as an individual on the amount that we make. Now, the board of directors, what does the board of directors do? The board of directors are elected by the stockholders of the company. So once a year, the stockholders do a proxy statement and they vote on who the board of directors are going to be. Usually they have terms of like 3 or 4 years and they're rolling. So every couple of years they'll come up for election and a new person every year will be elected or voted off. These are done by the stockholders. Now, the board of directors are responsible for managing the operations, the high-level operations of the company, and supervising the executive. So the CEO, CFO, these type positions are going to be elected by the board of directors, not directly by the stockholders. So we have stockholders over here. If we went and we bought stock in McDonald's, we're going to have a vote. We might not have a big vote because it's all going to be based on the number of shares that we have. But we're going to have a vote on who the board of directors are, and then these board of directors are going to hire and fire the CEO and the executives. And below that, the executives are going to hire their own people, like the managers and directors. So there's a little pyramid type thing, starting with the stockholders, but the stockholders only have a limited role in the operations and management of the company. The charters and articles of incorporation, these are the documents that form the corporation. There's some information about that in the chapter. Now, stock is our owner's equity of the company. Now, remember when we did our sole proprietorship, when we first started doing our entries, we had if we invested money in the company, we would debit cash and we would credit owner's capital, like James Webb Capital. Now we have common stock and preferred stock. This is the equity interest in the company. Now there's three different types of things that we need to look at when we talk about the stock. There's authorized, issued, and outstanding, and those numbers are continuing to decrease. So in our charter, we're going to have a number of shares that are authorized. That might be 10 million shares that, if we wanted to, that is the most that we could actually issue for the corporation. Now, what is actually issued is a different number. So we can issue up to the amount that is authorized. So we might have 10 million that are authorized, but we only have 8 million that we've issued at that time. We have another 2 million there that we can issue at a later time. Now, what is outstanding? Outstanding is an amount equal to or less than what is issued, and that is the amount of shares that are currently held by outsiders. Now, what we're going to look at later on is treasury stock. And treasury stock is the amount that the corporation goes back out in the market and reacquires of their own shares. So they were once issued, but we bought those back. They're no longer outstanding. So it might have been issued before. We acquire some of those back. So the amount between what is issued and outstanding is lower. Outstanding is just the amount that is held by outsiders of the company. Par value. What is par value? Now each share is going to be assigned a par value, which is just an arbitrary number. Doesn't really mean anything as far as the market price of the stock or how much the stock is issued for. Usually they're issued above par, but they legally cannot be issued below par. So companies usually put a par value of $1 or a cent on stock, just as a minimum legal capital that they have to keep around. Now you usually have two different types of stock. You're going to have common and preferred. You're always going to have common. A lot of times you're going to have preferred as well. What's the difference between the two? Preferred stock, as you hear by the name, is preferred, so they have first dibs on things. So they're somewhat like a debt instrument where they have to get paid before the common stockholders, but at the same time they're equity instruments having less of a preference than the outside debt holders. So preferred stockholders typically get the first return. If we made $1 million and in the preferred stock certificates they were supposed to get a dividend of $200,000, they would get that first before anything came out to common stockholders. So what is the advantages or disadvantage of being preferred? Well, you're going to get a more steady return if you're preferred, but your upside is going to be higher if you're a common stockholder, because once the preferred gets theirs, then the common stockholders can get the mass majority of what's left. If there's a really, really good year, the preferred is usually going to be stuck at what they are guaranteed in their contract, but then common stockholders are going to make a buku of money by what the residual is. In arrears, you often hear this, not just talking about dividends, but other parts of finance. If something is in arrears, it's overdue. So if we had preferred stock and we didn't pay their dividends in 1 year because we had a really poor year, often they have dividends in arrears, so we'd have to catch that up. So if we didn't pay in year 1, so we get to year 2, there's dividends in arrears from year 1 when we get to this new amount, and we declare dividends. Well, the preferred stockholders are going to get their dividends for year 2, also the dividends in arrears from year 1, before common stockholders are going to get anything. So, and that could accumulate over multiple years. So you might have 5 years of dividend in arrears that you need to catch up on before the common stockholders are going to get anything.